Good afternoon and welcome back to the video Talking Trust information sessions. This is the final episode in our four-part series where we host guest speakers who are experts in trust, law and taxation, and who will share practical information and insights aimed at helping you navigate your duties and responsibilities of being a trustee. I'm Ricardo Teixiera, Chief Operating Officer at BDO Wealth Advisors, and I'll be your host and co-presenter for today's Talking Trust session. Thank you for joining the conversation, and if you're listening into the Talking Trust series for the first time, please do look up the recordings of the first 3 episodes, which you can find on BDO's YouTube channel by searching Talking Trust. Today's webinar will also be recorded, and a link to the recording will be shared with you after the event. We have set aside time for an interactive Q&A session following the talk, so if you have any questions, please line them up by using the Q&A function, which you will find on the top right-hand corner of your screen. Just look for the speech boxes with the question mark. So we end the series by bringing together all the topics that we've previously handled and dealt with on the Talking Trust series. And we'll aim to do that today by bringing into perspective under the banner of trust administration. It's a fine line between a compliant trust and an alter ego of the founder or trustee. Proper management and administration of the trust on behalf of the beneficiaries is essential in ensuring that the trust remains valid and that the trust offers the benefits that were intended when it was first established. Today, I'm joined by Phia and Spuy, who you would have met as the guest speaker to part 1 of the Talking Trust series, when she hosted a talk titled The Burden of Trusteeship. Phia is a chartered accountant with a master's degree in local and international tax. She's also a registered fiduciary, practitioner of South Africa, and a master tax practitioner, as well as a trust and estate practitioner. She's a published author, and you will often read her opinion in the personal finance section of the weekend newspapers on all matters related to trusts. Phia and I today will discuss practical considerations in fulfilling your administrative responsibilities as trustees. So to kick off the conversation, let's consider some of the common administrative challenges that are shared by trustees that we see in practice. As a trustee, you're not alone in the frustrations and hurdles you face in keeping the trust up to date. These are trends that we see in practice, and I'm sure that you may well relate to some or all of these pain points that I'm sharing with you. Very often, trustees are not complied with is number 1, not understanding the powers that the trustees have, requirements for meetings and minutes, which are all contained in the trust deed, but often not understood. Availability of data is a big issue, not having resolutions, minutes, supporting documents available. And the key underlying theme we see here is that there's often no storage system for documents for a trust. And in actual fact, very seldom is there a central file. We find that each trustee has their own file. It's not shared. And so to get the single version of the truth is quite a challenge. Obviously, with trust, there's very often a family member involved who is a trustee. And what we find is that there's often a knowledge gap, and trustees may not know what they don't know. And this, unfortunately, can lead to unintentionally not complying with best practice or processes for changing trustees or changing the trustees. And we've seen situations where, for example, a trustee's been removed and that process hasn't been followed properly or correctly. And as a result, that transaction that the trustee signed on may not be valid if ever challenged by a court. And then another big factor that we see in the theme is the mobility of people. I think it's reality that over time trustees find themselves in different cities and countries and are not always available. And this often becomes a limitation in taking action and record keeping for trusts. And it's just really difficult to get people together, which becomes a hurdle. And a big no-no is we see trusts with no bank accounts or initial donation that has been recorded. And this is a cardinal sin in trust administration, but yet it comes across quite often. And so I think these are all, I mean, I can carry on, there's a couple more on the slide, but I think generally the point is that there are a lot of pain points and you're not alone. So what I'd like to do, Phia, if I can bring you in here, if you can maybe just take over and just share with us, why are trusts in such a mess?
Thanks, Ricardo. It's nice to be back. And we're really going to try and keep this a practical session. So just to recap very quickly, why the mess? What is the legal position of a trust? And I think that's where a lot of things go wrong, because I truly believe it's out of ignorance that a lot of people, don't get it right. And we'll also look at a practical example later. So just in terms of a trust, we've already said a trust is just a contract. It is a mere arrangement of assets where trustees are acting as the custodians of the assets in the best interest of the beneficiaries. So that is quite a mouthful. The trustees don't own the assets, they own it on behalf of the beneficiaries in their capacity as trustees, which brings about a very important role and a fiduciary role that these trustees have to fulfill. Many people think a trust is like a will. You have it drawn up by a lawyer, or an accountant, or a trust professional, and then it just gets into a bottom drawer, and people forget about it. They never read the trust deed. They don't execute the trust deed. Often family members are trustees, as Ricardo mentioned, and there's just no execution. A trust is not like a will. It has to be physically managed, even more than a company. It's very different to a company, actually. A trust is run by resolution, and you'll hear me saying that a couple of times today. That makes it very different from a company, and that's where I think a lot of people, get caught out. So that is critically important, that a trust is run by resolution. There's a number of court cases that refer to that. When we look at tax submissions, we know the great focus on trust the last couple of years. What's very unique with a trust, or even more important, a greater emphasis for trust, is the whole connected person rules. For those people who don't understand that or don't know that, SARS wants to know every related or connected person in relation to a beneficiary of a trust, because that's where a lot of the shenanigans happen. And we know typically with a family trust, it's family members who enter into transactions with the trust. So connected persons are particularly relevant, and it's very important to plot those persons, from the outset, and understand the implications that it may have on the various parties involved in the trust. In a trust, assets are treated as silos, also a very unique concept. So it's income and its related expenditure almost treated like a silo within the trust. And then, that could go right through to how you distribute, income or net income to different beneficiaries. So very important then for assets to be followed by the way it was funded, and its resulted income and expenditures resulting therefrom, and then how that gets distributed. The attribution rules, where SARS basically impute any income back to a funder, a person who has transferred assets into a trust, typically on an interest-free loan basis, like all the old trusts, were almost want to say guilty of. So those attribution rules, it's very important to link the asset with how it was funded, and then the resulting income tax consequences flow from that. And then also the distributions that I spoke about, once we understand our assets and their silos in terms of its related income and expenditures, then it's very easy to do distributions to beneficiaries and actually be ready to have a complete and an accurate tax return. Because once you hit the tax return, and then, you need to then understand, how each asset was funded and the resulting income and expenditures, then it's almost too late. I think it's also important these days to have an ability to do a bit of, forward planning in terms of what the tax consequences may be. So it's very important to have these, this information handy and really understand, what is at hand. So when we have a look at the different types of trust, we put them in 3 categories, which makes it easy for people to understand. We're trying and we aspire to have a valid, compliant trust. Now that's a mouthful. So a compliant trust is something that the master, that SARS, that creditors acknowledge, and I call them that a happy trust. So, that is when people are 100% in compliance with all the laws and in terms of the trust deed. A lot of people have heard the word alter ego. That means an extension of yourself. So that's typically where family members plan to set up a trust, but they literally treat the trust assets as if it's their own, and that causes a great problem. So the courts are saying we'll recognise that there is a trust, but we are going to disregard the assets in the trust for purposes of a divorce. If SARS attack you, or the case that we'll have a look at, where all the assets, are taken into account into a person's estate. So that is something we want to avoid at all costs. Your trust can be set up perfectly. The problem is the execution. A sham trust is obviously a trust that you never intended to have a trust. There's some court cases on that where the courts turn around and said basically what you try to achieve is a partnership. You just called it a trust. So that form of an entity does not exist. In other words, it never came into existence, very different from your alter ego trusts. And the courts often got this wrong and mix it up to call a sham trust, alter ego trust, and vice versa. But I think this picture makes it very clear. Alter ego trust does exist. Execution is a problem. Sham trust does not exist. The founder never intended to have a trust. So I think it will be best explained by means of an example. And I'm sure many of you, this is a very familiar picture, and people can relate to that because those funny orange blocks, the founder is a trustee, is a beneficiary, the whole family is kind of slap bang in all those roles. Now, the courts on its own don't have a problem with a person being a founder, a trustee, and a beneficiary. What is becoming very, very important, and as I will explain this case, the Brits case that happened in 2011, I really feel sorry for these people in a way. I don't know if it was ignorance or arrogance that made them lose the case. I wish I could attend this case because it's just unbelievable, the turn that this case took. So the Brits family, obviously, in 2000 was advised to structure their affairs in various trusts. So our multiple trust structures, the Zani Trust, the Ackerman Street Trust, and the Brazil Trust, and then ring fence their assets like people are told. So the ones you ring fence your assets, nobody can get to them. So surprise, surprise. So Izani Trust held the development, so property development, a risky development. So that's obviously why they ring fenced in there. The Ackermanstraat Trust, that was a trust that was established to hold the household content. And then the Brazil Trust, the trust actually acquired their residence with its own funding. So I thought that's kind of a tick, in terms of it wasn't something that the family owned before and then placed it into a trust. So I kind of tick, they've done that correctly. At the face of it, the Ackerman Street Trust, unfortunately, that was furniture, obviously, that they owned. It was paid up assets in their personal estate. They wanted to push that away from themselves to not allow creditors to penetrate, that trust. So they sold those assets to the trust on loan account because the trust didn't have its own money. So the loan account sat there, and then they just used their annual donations, which a lot of people do, use their annual donations to work down that loan. And the problem is, the court also said, the day before you had the trust, you used the assets, you owned the assets, you had full benefit of the assets. The day after you registered the trust, you had the full use, you had the full benefit, you were using it. There was absolutely no difference. So the courts basically turned around and said they don't like the way the trust was structured. So the trust deed, they referred to a couple of clauses they weren't happy with. But I think what got them was the execution. There was a problem with the execution, and that just boils down to very, very simple administration. As I say, it's either ignorance or arrogance that, in some instances, for example, the Brazil Trust, they refused to give the trust deed because FNB's lawyers, got to understand that there's further trust, but the Izani Trust, because the Izani Trust incurred the debt, obviously with FNB, and then the development went south after, it was okay for the first couple of units. And when it went south, obviously, Mr. Britt signed sureties because they didn't own anything in their personal name. So like a lot of people, are assured, don't worry, everything is in trust. You can go absolutely ballistic, sign sureties. That's what they've done. And when the bank knocked on their door and sent the sheriff was told, oh, sorry, we don't own any assets. Everything, belongs to trusts. And obviously, F&B's lawyers got fed up, and then they started digging, and then they realized there's other trusts as well, and they asked for information, and the Brits family just didn't provide some of the information, and so they ended up in court. So the courts weren't very happy, as I said, firstly with how the trust was structured, and then the execution. So the courts look at both, and the courts are quite fed up with abuse. I mean, this is coming. There's a Parker case in 2005 where the family took the land bank for absolute riot, and so the courts are getting fed up where creditors are prejudiced, through the way people are structuring their affairs and trusts. So they are taking a very close look to find, issues. So as I said, I was quite surprised. I think the Brits family, we have to give them credit. They've done some things right. They've done a number of things wrong. And I know with families it's very hard because you really want to protect your assets, and when you put it in a trust structure, you don't want to lose control. A lot of people have a big problem with that, so you have to relinquish control. That is the absolute critical point. So for a trust to be not attacked as an alter ego trust, it's all about separation of the ownership of the asset and control of the asset. Now, ownership, it belongs to the trust. And the control thereof must be done by a board of trustees who act very independently and can actually demonstrate that they've applied their minds. So what have they done right in this case? So they structured the trust very well. The trust deed in terms of protecting themselves. They could appoint trustees. Nobody could remove them. They could make decisions whatever they want. They could distribute these assets to themselves if they so wished. They had full discretion to do that. They could terminate these trusts whenever they wanted to. So I think from a structuring point of view, it was pretty well done. But I think that's just, irritated the courts even more. So I think if you decide to get yourself protection by structuring the trust properly, you better make very sure your administration is done very well. Otherwise, you're going to be open for attack. So the trust deeds were structured pretty okay. They had powers to use the assets. They had powers to rent the property out. So they were certainly empowered to do whatever they intended to do with the transactions. The courts also spoke about simulated transactions, but when you just look purely at the powers, they had the powers to do it. So as I said earlier, the Brazil Trust did acquire the property through its own resources, a Standard Bank bond, which I think was cool. They had financial statements for the Ackerman Street Trust. That was the household content, so that they did provide that. So that was a tick the box. And I think a lot of people think if you got financial statements, that's compliance. I published an article yesterday. Financial statements does not demonstrate compliance. And I think this case just illustrated it yet again. The Brits family claimed in court that they listed these assets separately, unlike the Bardenos case where the guy listed his trust assets as his personal assets when he did when he applied for funding. So these guys at least on paper showed it as not belonging to themselves. What did they do wrong? The court said the object of the trusts were flawed. They had absolutely no commercial reason for setting up these trusts. There was no estate planning reason why they did it. The pure reason why they did it is to shield themselves from creditors, and the court had a problem with that. So we must make very sure that the objective of us setting up a trust is very pure, either commercial or estate planning purposes. We spoke about the powers and controls in the trust deed, absolutely controlling it. There was no lease agreements. There were no minutes. There was no bank account. They, as I said, the way they treated the assets, there was no physical, handing over of the assets, which I don't know how the court wanted that, but the household stuff that they use, there was no physical handover. They didn't pay rental. The bond that was taken out by Standard Bank in the Brazil Trust, the court said, how do you not have a commercial rationale to generate income of some sorts, yet you've got a bond obligation, so it does not make sense. So the fact that they didn't even have a bank account meant that the Brits family paid the bond payments on the trust's behalf. So you can see the cash flow, the paper trails was just absolutely, it was simulated transactions, right? If you look at how they actually treated it. So when we look at these, I think it's very clear that even though you may have the trust deed perfect, the execution, there are a lot of little things that you have to do. They didn't have minutes. So, I am saying, they obviously haven't really acted in accordance with the trust deed, because the trust deed often said, well, you have to open a bank account. That's Trust Property Control Act. And then you also have to have at least one meeting per year. They couldn't provide evidence. So, the court just assumed that, these things weren't in place, which I think they were probably right. So just to summarize what we believe the pillars of trust administration is, we group them into 4 headings. So contractual obligations, I think, that deals with the trust deed. So you always go back to the trust deed. You look in there in terms of what the powers are, the trustees, what processes they have to follow to make decisions, do they have to have at least one annual meeting a year? So you always go back to the trustees. A very important thing is trustees, because trustees have to sign the resolutions. So it's very important for trustees only to act as trustees once they've got a letter of authority, and you have to have your systems and your processes in place to let people only sign when they're physically appointed by the Master of the High Court. There are some court cases where property transactions fell through because not the right trustees have physically signed the resolution. So it's literally as important as that. So you always go back to your trust deed. Often people don't read their trust deed, so it's very important to at least understand. We're sitting with lay persons, often family members who are not legally inclined. A lot of the trust deeds are really technical. So I think it's very important to crystallize the important things to focus on, to make sure you're not acting in contravention of your trust deed. Records of decisions and meetings. A trust is run by resolution. You can't get around it. That resolution has to be done first. Then you can execute the transaction. Then the cash has to actually flow out of the bank account of the trust, unlike with the FNB case. Those decisions are very important. So just in terms of the contractual obligations and the trust deeds, I don't know, Ricardo, on your side, have you got a mechanism to help people to, keep track of what they should be doing, who's trustees, who can't sign, who can sign, and who should sign?
Absolutely, Phia. And I think that is a point. I think without a system of control, administration really does become a burden. And as you've said, mistakes happen. And like in the Brits case, Phia, these aren't big mistakes. They're just really common errors. And we see this in practice. And so I think the reality is that administration is often underestimated or overlooked. And like you've said, the focus is on financial statements and tax, but that's only 2 of the keys to administration. The third key is governance. And in our experience in practice, governance deals with, as you've said, Phia, understanding the trust deed, recording decisions, document storage is vital, being able to access the information, and then evidencing that you've had meetings. So I think the point that I would like to advocate is that if you're going to get this right, you either need to up your knowledge on trust administration and management and do it yourself, or you need to get help and work with a trust officer. But I think in any event, you need to have a reliable system of control. And I think, as you've said, in our experience, what we found is very useful is using technology. We use the BDO Trust Portal, which together with a dedicated trust officer really supports trustees. And this trust portal creates a digital file, which is accessible and is transparent for all trustees and can be accessed from anywhere in the world at any time. So I think what we'd like to do now, Phia, is maybe let's just delve through some of those pillars, or let's delve through all 4 of the pillars and look at what the Brits family could have done differently. Yeah. Would you like to talk through some of these briefly, or can I just go straight into demonstrating how we could do this in practice?
Contractual, I pretty much spoke to that slide.
Thanks. Let's do that. So if I just start with contractual, I think the point here is that you've got, there must be a need to know what's in your trust deed. A trust deed is a contractual sort of obligation of a trust. And what I'm showing you on screen is a digital version of the trust deed. What you want to do is you want to be able to have a quick reference to your trust deed, not having to go back and read the trust deed whenever you have a question as to must trustees rotate, who can sign documents, who are the beneficiaries, and more importantly, what are the powers of the trustee. So what we use through the BDO Trust Portal is an automation facility where we can digitize the trust deed. So in this example here, this trust is not permitted to lend money or grant credit, but it can manage trust property and it can borrow money. And these powers then flow through to any action that the trustees can or can't take in time. I think also linking up to the comment you made around members, Phia, it's vitally important to know at what point in time who fills what block or who sits in what seat in that trust. And so knowing who's the founder, who the trustees are, who's independent, who the beneficiaries are all important. In this instance here, as an example, we have a trustee, Terina Jardim, who has resigned, but yet we're waiting for that to be registered with the master. So at this point in time, if any trust action is to be signed, Terina would have to be part of that because she's still a trustee according to the letter of authority issued by the master. And often that trips up trustees when they think they've signed, handed in a resignation, they're out of it and they've absconded from their responsibilities. So I think here that talks through some of the contractual sort of solutions that we see in practice. You want to just maybe position the records and decisions, or should I jump into that?
Yeah, I think basically, just quickly, I think we see difficulties. People need help, but yet you need the active participation of the trustees. So people are really laypersons, and they really want a quick method to access resolutions, because often there's a property deal to be done. You just don't have time to find trustees, find a resolution, find a format. So it's scrambling around to get the necessary in place. You always have to remember resolution first and then transaction. So I think it's the discipline first of all to get your processes right. The second thing is to have things handy to make it easy for people to access, to enable them to actually comply. Same with meetings. You have to follow process in terms of the trustee. You have to allow people to meet. Often we see, conflicts between what, people believe have been discussed and, what actually come out in the minutes. The minutes often don't get finalized because it's just too much a step of, sending them around. So the record keeping, and that's one thing we saw really get to people, is your trustee said you will have that one meeting a year. Show us evidence. Similar to the FNB case, if they just had that, it may have helped them, So just in terms of, again, technology, I think there are easy ways to facilitate the process, get the active involvement of the trustees, and be able to demonstrate that, they have been complying.
Let me jump in there, Phia. Let me demonstrate some of the solutions that are available in terms of actually managing the recording of decisions. And like you said, meetings. Meetings are critical, and they may be held, and if they are held, it's the collection of the documentation around that. So here's an example. By using technology, you can create a meeting through the Trust Portal, and once I create a meeting, I can send an agenda, notify all the trustees of this meeting, and once that meeting's scheduled, there's a phone number to phone in for a conference call. And if I just give you a practical example, looking at the initial trust meeting here, here's an example where we can actually look at the recording from this meeting. If we look at the recording, I'll just pop to it there. This recording was made of the meeting.
Investment review.
And it will be held in perpetuity on
I have circulated the share portfolio investment statement. Are there any questions regarding that investment statement?
So the benefit of having an audio clip for a meeting allows you to capture minutes. So if we look at the minutes, here's an example of using technology again, Phia, is that we can actually collaborate and type minutes together. So right now I'm online as a trustee. I've got Rashika and Terina who are both online, color-coded. We can now all start editing these minutes. I'm going to delete, actually Terina and Rashika, maybe you want to edit those minutes while we're online. And what we've got here is the ability to actually simply create minutes. Minutes are a bit of a burden, and all you want to do is just make it really effective and simple to do. So if we are working on this minutes together, we can actually all start typing and collaborate on it. So right now, Terina is starting to edit point 3 of the resolution, and I see Rashika is editing the dates. What this allows you to do is save minutes. We can save that version, and once we've done so, we can actually export those to any format and circulate it to trustees. So I think, Phia, to your point, you've got to be able to evidence that you've held the meeting and that you actually have recorded those decisions that you've made.
Yep, that's a very useful tool.
Yeah. Thank you. So do you want to take us through the documentation, Phia?
Yes. Like people in property always say, it's location, location, location. I think for trust, you could say it's documentation, documentation, documentation. Because without documentation, you are going to be labeled an alter ego trust, guaranteed. And again, if the Brits family just, were focusing on this and could produce the necessary documentation, such as lease agreements, minutes, etc., if they opened a bank account, if they could demonstrate that the bank account was used for all trust transactions, it could have taken them a long way. And I think it's really that discipline. Often people say, I'll just pay from my personal account. You could just bring it in a loan account. I think it's just the wrong behavior. We have to force the right behavior to make the trust pay its own expenses, to have the trust, receive its own income in its personal bank, or in its own bank account, because that's a requirement of the Trust Property Control Act. And it's so important to have the audit trail. So once you've got your resolution, once you've got your supporting documents, to actually link that to a transaction, and to be able to demonstrate that you have the necessary supporting documentation. Documentation and administration makes up financial statements. Financial statements are not done and you reverse engineer and go and look for resolutions to be done. And then obviously support storage of these documentation. I think especially in today's age, people want access to information. So like you said earlier, often there's not even one file, there's just one central file, and there's a couple of trustees all over the world. So I think digital ability allows different people, different trustees to have access to all information, and then to make sure you have one repository where all trust-related documents are stored. And then the Trust Property Control Act requires storage of trust documents for 5 years after termination of the trust, not a rolling 5-year cycle like we have with SARS. So that's a very onerous requirement in terms of our law to keep trust documentation, which trustees have to adhere to. And we very, very infrequently see that people do adhere to this.
Absolutely. Phia, may I show you an option, a practical solution that if the Brits family had, possibly may have saved them from a bit of stress. So if I can go through here. Sorry, I can't get through to my slides. There we go. Okay, so let's start with the bank account. I think the bank account, like you said, is important. Do you actually have a bank account? And if you do, are you actually following the cash transactions that take place? So here's an example where this trust has an Investec bank account and it has a Momentum investment. But we can easily upload statements for each of the months of the year and making sure that we can review those transactions. Once you've got transactions, as you say, Phia, you then create the record and documentation for that. I'm just going to toggle back here through to recording decisions and documents. I think creating documents for trust actions is at the heart of everything that creates a compliant trust. And often what we find in practice, it's the access to knowing what documentation to use when. So it's a practical solution where having a library of typical trust actions that trustees are permitted to and are empowered to do, you can actually have quick access to all the documents, typical templates that you would need, whether that's for distribution or whether that's for investments. So if we're making an investment in listed South African investment, I would really open up that resolution and this would be pre-populated with everything that's held within the trust database. And I can then complete that document and circulate it. If I'm wanting to take an action such as lending money, which I'm not permitted to do, those templates are blocked out. Make loans, it's not permitted. And so by linking the trust deed to the trust actions, you start limiting the powers and reminding trustees what they are permitted to do. Using this portal to create documents to support the transactions and the decisions that were made by trustees, you can also simply circulate them through DocuSign. And once they're circulated through DocuSign, they would then be filed. Let's say we're going to add it to a resolution folder, upload it, it will then be circulated, signed digitally, and stored in the document storage folder. if I may then just toggle through to that document storage folder. Oops, it's this one over here. So document storage folder is a really good old traditional filing system, but this is digital and it's accessible from anywhere in the world by any trustee. So you have one file, one version of what the trust documents are. You can add folders, add documents, and quite easily just access documentation, whether that's speaker documents. So in this instance, if I wanted to open up a document, I could access all my FICA documents through the trust. I could also open up resolutions that we have saved. Here's an example of a resolution that has well, 3 resolutions, one that's been submitted for signature, still not fully completed. I see that Tarina Jardim and myself have signed, but Rashika Hararul and Jean Jardim are still to sign that, which has a lovely sort of track record. And then looking at a resolution that has been signed, you can really have a look at opening it, downloading it, and having a digitally signed document on file for documentation. So I do think, Phia, that having a system in place is quite a smart way to actually take away the burden of administration. Phia, would you like to take us through the last pillar of good trust administration, and that's dealing with accounting and tax compliance?
Yes, it's interesting to see that we put it last and not first. And we have spoken about the sequence of events. However, I think it's often frustrating for accountants to compile proper financial statements, and you can often see in the quality of those financial statements that information wasn't, at hand in terms of proper reporting on trust activities. Often the quality of the financial statements we see just do not provide sufficient information regarding the activities that happened in a trust. So what is important is obviously the administration documentation should support the financial statements, and it's the onus of the trustees to actually identify, and record the trust property. So it's not a requirement to have financial statements in terms of Trust Property Control Act. So, Trust Property Control Act is pretty old. So, that's, they need to identify and record trust property has been translated into, they have to keep an asset register. Now, asset register pretty much should indicate the description of the asset, its location, its value, etc., and it must be a complete list of every single asset that the trust has acquired. And so I think in terms of the uniqueness of the trust accounting and taxation, we have spoken about that. It's important right from the beginning to identify every transaction that happens in the trust, link that to a transacting entity, and then you need to know whether that transacting entity is a connected person in relation to the trust, because that has got important tax consequences. And when people prepare the tax returns, it's even worse than the accounting, because the availability of information is just not, to the extent that allows, tax practitioners to prepare financial statements. We've spoken about the silo effect, to treat each asset, kind of on its own as a silo. The whole attribution rules that we spoke about, where income gets imputed back to the funder. We've got the distribution, the conduit principle, where we can distribute income to beneficiaries. So you can see that the trust is the taxpayer of last resort. It's very hard to complete a trust tax return, and without complete, accurate, detailed enough information, it is really hard to enable somebody to complete a tax return properly. And we know with the magnifying glass on trust for the last number of years, for us who complete tax returns for trust, you can see the type of questions SARS is asking. So we better get our ducks in a row to make sure that whatever's ending up in the tax return is supported right back to supporting documentation. So I think, again, to use a digital system to support that and to enable, especially, if you have your trust administrator, you've got an accountant, and you've got a tax practitioner, even if they work in the same organization, it's very important for them to have access to the same information, to enable them to use the same source documentation and make sure all the data is consistently used throughout the reporting, the tax return, and when questions get asked by SARS, to drill down to an actual document. So again, yeah, I think Ricardo, this is really where it hits the tar road in terms of, are you able to demonstrate that what you're reporting you can support through documentation and minutes of meetings and resolutions.
Absolutely, Phia. And I think if I just pick up on the asset register, it sounds like such an innocuous requirement, but yet so important, and it is very seldom done. We see that financial statements are prepared, and they'll have the assets and liabilities, and they'll have the fixed asset sort of note, but it doesn't have enough detail that's required in terms of the Trust Property Control Act. So here's an example of what an asset register should look like. It should have all the assets when they're acquired, should have detail on the valuations, details on the costs, and you should be able to record any sort of changes to that. So in this instance here, if I was to add another, improve the value of this asset, let's get my screen right, I could easily sort of start recording what we are going to be doing for this property. I'm going to be taking out a new loan, and all of a sudden I can add the resolution here, attach it to this decision, and I can make sure that I've recorded and attached this loan through to this asset. So I think the asset register must not be underestimated. And then I want to pick up on the connected persons that you spoke about. This is looked at very lightly in practice. We find very few trustees that actually pay enough attention to what you've described, Phia, in terms of obligation to SARS. So what we found, again, using a database, is we can start keeping track of who are the entities, let's call them transacting entities, that are engaging with the trust. So here's a long list of everyone engaging. Phia, I've added you as a transacting entity. So let's see who you connected to. So here we go. Oh, Phia, you are related to me. Surprise. And you are also related to Tumelo, the beneficiary. And so I think what that starts, now at face value, Phia wouldn't seem to be a connected person, but if the trust is paying Phia, we can see that there's definitely a connection between her and the beneficiary to this trust. And so I think having data available becomes quite a powerful way to actually solve that burden of administration. So if I may just, I think, wrap up the conversation here in terms of looking at the 4 pillars. I think it's fair to say that trusts are unique structures and very unique legal vehicles, and very bespoke in terms of the law that they are based on. And there's very limited regulatory control and oversight. So hence the burden rests largely on trustees. And it's you as a trustee, your ability to actually administer the trust's specific requirements. So when you break down the legislation and best practice for the governance of trusts, it's clear that a trust's validity rests on these 4 pillars that we've spoken about today. So I think do yourself a favor and ensure that you have a trust administration solution and controls that can address these aspects. Ultimately, good administration is a trustee's insurance policy to ensure that you have a compliant trust. So I think I'd like to pause there. We've got a couple of minutes for questions, and I see that we do have a couple of questions that have come through. Phia, I'm going to put you live so that we can actually take through the questions, if that's okay with you.
Perfect.
Perfect, let's do that. Okay, sorry, there we go. So I think the first question, thank you, Richard King. Question Richard's asked is, trustee meetings via platforms such as Zoom, are they supporting a round robin resolution signed and then scanned digitally and held at a central point? Is this an acceptable evidence of the meeting, Phia?
I always send people back to the trust deed. That is our document that we rely on in terms of what is allowed and what is not allowed, especially as far as decision making is concerned. The modern trust deeds hopefully all allow digital means of making decisions and electronic means. So your electronic meetings, your round robin, through email, your digital solution, Ricardo. So I think it's very important to always make sure you act in accordance with the trust deed, and every trust deed is different. So don't assume that that's the norm or it's allowed. If it's a very old trust deed and they say you will physically meet, I've seen those trust deeds, then you will physically meet. So rather amend your trust deed and not be caught, once you end up in court for some reason, and then, you haven't acted in accordance with the trust deed, because that's your constituting document.
Right, exactly. And I think that's exactly right. It is the trustee that forms all the contractual obligations. So refer back to that. Another question from Richard King, if I may. Is it necessary to maintain signed minutes in a bound minute book or a lever arch file? Will that suffice as minutes?
Again, I think traditionally we had our books, it was held in a central place, and, they pasted them in with Prit, what was that those days? We've modernized now. Again, unless your trustee is very restrictive in terms of formalities that have to be kept, it is evidence, and, it's acceptable that electronic means are acceptable, digital signatures, etc. And we have clarified with the master, just, generally when the directive came out in 2017, the big master directive, they had digital signatures even for the master in there until the last draft, and then they took it out. So they are leaning towards that, and we asked them why they haven't kind of, finalized it and agreed to it. They said they just weren't ready yet. So we confirmed with them any internal meetings of trustees, internal documents, they do not have a problem with digitally. Obviously, as long as your trustee allows it, but for submissions to them, it's still manually at this point.
Thanks. And I think, Phia, just picking up on that, having a manual file of minutes is acceptable. However, it's the continuity of that file and accessibility to it when you need it.
And I think that's where it becomes problematic, Ricardo, where you explained, trustees are sitting all over the world. Accessibility there too. I've been told that by a client recently was with one accountant 40 years, and then the accountant immigrated to Canada and literally destroyed all the files before he left. So it destroyed the whole trust's existence, because how is he going to prove that he kept documentation for 5 years after existence? So it is really problematic actually to have one hard copy somewhere.
That's right. Absolutely. Phia, let's take one question, then we'll close. From Anonymous. Are instructions regarding distributions to beneficiaries recorded in a letter of wishes by the donor regarded as a legally binding document? I think that's a good question.
It is a good question. A letter of wishes is absolutely not binding, and I think people should be very careful to be, instructing, in terms of what trustees should be doing, especially if your trustee, determines that it's a discretionary trust and the trustees can use their full discretion. I think it's very dangerous from an estate duty point of view to start instructing, and eventually maybe fall foul of Section 33D of the Estate Duty Act. So be very careful. I think that's why it's so important to appoint the correct trustees, to share the founder's intention or understand the founder's intention, and obviously they can consider any wishes of the founder. Can certainly never be instructions, because then it's not a discretionary trust.
Correct, that's right. Phia, thank you for taking the time to be with us today. I think you've been practicing as an independent trustee for many years, and I think you've added a lot of depth to the conversation. So thank you for sharing your knowledge, and your experience has been very informative. I'm going to close now at that. Thank you, Phia. Thank you to everyone who's joined today's conversation. I think we've truly enjoyed hosting you and the conversations on trust. The recordings for each of the 4 parts in this series will be shared with you, so that you can refer back to the topics discussed and the practical insights that have been shared. You can also access the Q&A from each of the episodes on our website, including today's, which we will then post for all the questions that we haven't yet answered. And may I remind you, if there are any specific questions that you have which you would like us to address, please feel free to reach out to BDO on taxation, administration, or the management of trusts. I'd also like to, invite you to continue talking trust with BDO. We are here to help trustees and take that burden of trusteeship away. So let's have a cup of coffee and see how we can help you. Thank you for participating. Stay well, stay safe. Till we connect again. Goodbye.